Welcome back to Report of Silver, where we go beyond the headlines and uncover what is really happening inside the global gold and silver markets. If you are holding physical silver right now, whether it is in your safe, your investment portfolio, or sitting in a private vault somewhere in the world, today's analysis could change how you think about this market completely. Because what happened in May 2026 may become one of the most important turning points in modern silver market history. China has just announced export controls on strategic metals, and while many investors initially thought this was just another political headline, buried inside that announcement was something extraordinary. Silver was included, not restricted, not lightly regulated, effectively blocked from leaving the country. And if this policy remains in place, even for only 90 days, it could trigger one of the most significant physical silver supply shocks we have seen in decades.
Now, at first glance, the market does not seem overly concerned. Silver is trading around $76 per ounce. After the announcement, prices briefly jumped by about 4%. Then settled back to close only modestly higher. To many traders, that looked like a calm and rational reaction. But as silver analysts, we know price alone never tells the full story. The real truth is usually hidden deeper inside the physical delivery system, inside the vault inventories, inside the movement of real metal. And that is exactly where the warning signs are now flashing. Before we go deeper, I want to ask you something. Are you watching silver simply as a price chart, or are you paying attention to physical inventory levels in New York, London, and Asia? Because in times like this, those two things can tell very different stories. Let me know in the comments whether you track physical silver supply data or whether this is your first time looking at the market through that lens. I read every comment, and it helps shape future analysis here on Report of Silver. Now let's break down what actually happened. On May 15th, China's Ministry of Commerce issued a new directive classifying silver as a strategic resource. Officially, they described it as an export licensing measure tied to national security, industrial priorities, and resource preservation. On paper, that sounds technical and temporary. But in practice, it functions like an outright ban. Companies can still technically apply for export licenses, but industry contacts in Shanghai report that no approvals have been granted. Applications are being accepted, but they are simply being delayed indefinitely. In plain English, that means silver is no longer leaving China, and that matters far more than many investors realize. China produces roughly 3,600 metric tons of silver every year. That translates to approximately 115 million ounces annually, representing around 12% of global mine production. But that is not the number that matters most. The real number is how much of that silver flows into Western markets. Estimates suggest China has been exporting between 80 and 100 million ounces per year. When you include refined silver, semi-manufactured silver products, and additional flows routed through Hong Kong. That is the metal that has quietly been feeding global demand and supporting Western inventories. Where has that silver been going? Primarily to three places. First, to COMEX vaults in New York, which support the world's most important silver futures market. Second, to LBMA vaults in London, which remain one of the largest physical precious metal storage systems in the world. And third, directly to industrial manufacturers across Europe and North America. Those flows have now stopped. That changes everything. Let's look at COMEX. Current total silver inventories are sitting near 285 million ounces. At first that sounds healthy, but here is what most people miss. Only around 62 million ounces are classified as registered silver. Registered means immediately available for delivery against futures contracts. That is the silver that actually matters when demand rises. And over the past 16 months, COMEX inventories have already been falling steadily. Nearly 90 million ounces have disappeared since early 2025. That decline was gradual enough that most analysts ignored it, but now the main source replacing that metal has been cut off. If Chinese supply remains unavailable for just 90 days, current projections suggest registered COMEX silver could fall below 40 million ounces by August. If the restrictions become permanent, that number could move below 25 million ounces by the end of the year. To put that in perspective, North America consumes roughly 180 million ounces of silver annually across industrial demand, investment demand, and jewelry demand. A 25 million ounce registered inventory is not a comfortable buffer. It is barely enough to cover a few weeks of serious delivery demand. And New York is not the only concern. London faces the same risk. The LBMA holds roughly 950 million ounces of silver in total vault holdings, but only a fraction of that is actually available. Much of it is already allocated or otherwise committed. Analysts estimate only 220 to 250 million ounces are truly available for movement. China and Hong Kong have accounted for nearly 20% of the metal replenishing those vaults over the last 18 months. That replenishment has now stopped as well. This is the key point every silver investor must understand. This is not simply about mine production. This is about marginal supply. the extra silver that quietly keeps the global system balanced. Mines cannot suddenly increase production overnight. New mines take years to develop. Recycling responds slowly. And when investors are accumulating silver instead of selling it, recycling actually falls. That means the market depends heavily on these invisible trade flows to stay stable. That hidden support system just disappeared. And that is why this story matters so much. The silver price may still look calm today, but underneath the surface, the physical market is beginning to tighten. Inventory drawdowns are accelerating. Supply chains are shifting. And if history teaches us anything, markets usually ignore these signals right up until the moment they can no longer be ignored. In the next part, I'm going to show you why China made this move right now, and why the timing may tell us even more than the policy itself. They represent a direct shock to one of the most important physical supply channels feeding Western silver markets. The immediate price response has been small, but the physical market is already showing signs of tightening. Now the next question becomes even more important. Why did China make this move right now? Why May 2026? Why silver? And why now? To answer that, we have to step back and look at the bigger strategic picture, because this decision was not made in isolation. It was driven by three powerful forces converging at the same time, and once you understand them, this silver export ban starts looking much less temporary and much more structural. The first driver is industrial demand, especially inside China's own economy. Silver is no longer viewed only as a precious metal or investment asset. It has become a critical industrial resource. It is essential for solar panels, advanced electronics, semiconductors, electric vehicles, battery systems, and next-generation communications infrastructure. And no country in the world is expanding those industries faster than China. Over the last several years, China has aggressively invested in domestic semiconductor manufacturing. That push accelerated after the United States imposed tighter chip-related export restrictions in 2023 and 2024. China responded by making technological self-sufficiency a national priority. At the same time, China expanded its already dominant position in solar energy manufacturing. Today, the country produces roughly 40% of the world's solar panels, and that number continues to rise. Both of those sectors consume enormous amounts of silver. Industry analysts estimate that China's domestic industrial silver demand has increased by approximately 25 million ounces annually over the past 3 years. That is a massive increase in internal demand, and it changes the country's incentives completely. If Chinese policymakers are forced to choose between exporting silver to Western markets or reserving that silver for domestic industrial expansion, the answer becomes obvious. They keep it at home. From their perspective, exporting strategic silver while building a national technology base would make no sense at all. But industrial demand is only part of the story. The second factor is monetary strategy, and this is where things become even more interesting. Most investors already know that China has been accumulating gold for years. Official reserve data shows steady purchases, but many analysts believe the true level of accumulation is far larger through state-linked entities and sovereign institutions. Gold has clearly been a strategic priority. What fewer people discuss is silver. China does not publicly report official silver reserves in the same way it reports gold. But when analysts study customs data, refinery outputs, domestic inventories, and import flows, a different picture begins to emerge. Many believe China has been quietly accumulating silver since at least 2020. Estimates vary widely, but some place Chinese state and quasi-state holdings somewhere between 400 million and 800 million ounces. That is a huge amount of metal. Why would China want that much silver? Because silver is not just an industrial commodity. It is also a monetary metal. In any future system where global trade becomes less dependent on the US dollar, hard assets become more important. China has been actively building alternative trade structures through BRICS partnerships and bilateral agreements. In a commodity-backed settlement system, gold may handle large sovereign transactions, but silver provides flexibility. It can support smaller transactions, industrial backing, and broader strategic reserves. Seen through that lens, restricting silver exports makes perfect sense. China strengthens its own reserves while limiting access for competitors. That is not simply commodity policy. That is monetary strategy. Now let's move to the third factor, and this may be the most sensitive one of all: geopolitical leverage. Silver is essential to modern defense systems. It is used in missile guidance systems, advanced radar, aerospace electronics, military communications, and precision munitions. In the United States, silver has long been recognized as a critical material for national security applications. That means controlling silver supply creates leverage, and China understands that very well. By restricting exports, China is not not just tightening industrial availability, it is increasing Western vulnerability. If the United States and Europe face shortages in a strategically important metal, they are forced into difficult choices. They either consume existing stockpiles, pay dramatically higher prices, or negotiate from a weaker position. This strategy is not new. In 2010, China used a very similar approach with rare earth elements. At the time, China controlled roughly 95% of global rare earth production. Following geopolitical tensions with Japan, Chinese exports suddenly slowed through licensing delays and administrative restrictions. At first, markets barely reacted. Most participants assumed it was temporary, but within months, prices exploded. Some rare earth materials rose by 500% to 1,000%. Manufacturers panicked. Governments scrambled. China had demonstrated something important. Commodity dominance creates geopolitical power. Today, silver appears to be following the same playbook. Think about the pattern. Domestic demand rises sharply. Strategic accumulation increases. Geopolitical tensions intensify. The resource is reclassified as strategic. Export restrictions are implemented under the language of national security. That is not an accident. That is a coordinated policy decision. And this is why I believe many investors are underestimating the significance of what happened in May 2026. They are treating it as a short-term trade story, but it may actually be part of a much larger global realignment. The world is moving toward fragmented supply chains, competing economic blocks, and strategic control of critical resources. Silver is now part of that system. That changes how we should think about price. When a commodity becomes strategically important, its price is no longer determined only by supply and demand. It begins reflecting politics, national security, and strategic stockpiling. Those forces are far less predictable, and they often create sudden price moves that traditional market models fail to anticipate. So now we know why China acted. The next question is what happens next. History gives us a powerful clue. To understand what may happen next in silver, we need to look backward. Markets rarely move in completely new ways. The headlines change, the countries change, and the assets change. But human behavior and supply chain reactions usually follow familiar patterns. And there is one historical event that may offer the clearest roadmap for what we are seeing right now. That event was China's rare earth export restrictions in 2010. At the time, China controlled around 95% of global rare earth production. These were not household commodities, but they were critically important materials used in electronics, clean energy systems, advanced manufacturing, and military technology. For years, Western countries had allowed themselves to become dependent on Chinese supply because it was cheaper and easier than building domestic production. Then everything changed. In September 2010, following a political dispute with Japan, China suddenly restricted rare earth exports. It was not announced as a dramatic ban. It happened through tighter regulations, delayed permits, and administrative slowdowns. At first, markets barely reacted. Investors assumed it was temporary. Analysts called it a political signal rather than a real supply event. Industrial buyers believed existing inventories would be enough. Sound familiar? That is exactly what we are hearing about silver today. Back then, during the first month, prices moved only modestly. Nothing dramatic. Most people ignored it. But then the physical market began to tighten. Delivery times increased. Manufacturers started competing for available material. Inventories began to fall. And once that happened, price behavior changed completely. By early 2011, some rare earth materials had risen by 500%. Others surged by nearly 1,000%. Not because supply had fully disappeared, but because the market suddenly realized the restrictions were real and lasting. That realization created panic buying, and panic buying created vertical price movement. That is the pattern investors must understand. Markets do not usually price in supply shocks immediately. They price them in stages. First comes disbelief, then concern, then confirmation, then panic. Right now, silver appears to be in the disbelief stage. Prices moved only slightly after China's announcement. Most mainstream commentary still describes the policy as temporary. Traders are treating it like noise. But that is exactly what happened during the rare earth crisis. The first reaction was calm. The real move came later. Now, silver is not identical to rare earths. It is a larger market. It is more liquid. It has more diverse production sources. But the structure is remarkably similar. China controls a major portion of marginal supply. Western markets depend on that supply to maintain inventories. Restrictions were introduced suddenly under national security language, and the market has responded with surprising calm. That calm should not reassure you. It should concern you. Let's think about the timeline. In the rare earth crisis, month 1 was denial. Prices moved a little, but markets remained relaxed. Month 2 brought visible delivery delays and rising concern. Prices accelerated. By months 3 and 4, inventory shortages became undeniable. That is when panic began and prices went vertical. Now compare that to silver. We are currently in month 1. China announced the export controls in mid-May 2026. Prices initially jumped, then stabilized. Western inventories are already under pressure. COMEX registered inventories are not rising. LBMA available supply is tight, and industrial demand remains strong. That means the next 60 to 90 days may be the most important period in this story. If physical inventories continue to fall through June and July, confidence in current pricing will begin to crack. Industrial users will not wait until vaults are empty. They will start securing supply early. That is what rational buyers do during uncertainty. And once multiple industrial users begin doing that at the same time, available supply disappears faster than expected. That is how shortages accelerate. This is also why silver behaves differently from many other commodities. Silver serves two very different markets at once. It is both an industrial metal and a monetary metal. That creates a unique feedback loop. If industrial users begin stockpiling because they fear shortages, and investors begin buying because they fear rising prices, both groups end up competing for the same physical metal. That is when things can get explosive. We saw something similar in 1979 and 1980 during silver's most famous price spike. Many people remember the Hunt brothers, but they often misunderstand what actually drove that market. Yes, large-scale accumulation played a role. But equally important was the perception that supply was becoming scarce. Investors believed available silver was disappearing. Once that belief took hold, prices did not rise slowly. They surged. Fear changes market behavior. People stop asking whether they should buy and start asking whether they still can. That psychological shift is what turns a normal bull market into a supply crisis. And this is why China's decision matters so much. This is not a weather event. It is not a mine accident. It is not a temporary transportation issue. It is a deliberate policy action by the world's second largest economy. That makes it harder to reverse and much more difficult for markets to dismiss over time. If China extends this policy beyond 90 days, or even signals that it may become permanent, the market narrative will change overnight. What currently looks like a temporary disruption will suddenly be seen as a structural shortage. That is when repricing happens, and it rarely happens gently. Now let's bring this down from the macro level and make it personal. What does this actually mean for you? Because depending on how you participate in the silver market, this China export ban could affect you in very different ways. A physical silver holder, an industrial user, and an investor holding paper silver may all be exposed to the same market, but they are not exposed to the same risks. Let's begin with physical silver holders. If you own physical silver right now, whether that means coins, bars, allocated vault storage, or large institutional holdings, this development strengthens one of the core reasons many people buy physical metal in the first place. Physical silver is not just a price trade, it is direct ownership of a scarce asset. And during a supply disruption, scarcity matters more than price. That distinction becomes critical in moments like this. Today, silver is trading near $76 per ounce. On paper, that looks like the market is functioning normally. But underneath that headline price, something very different may be developing. Large industrial bars meeting delivery standards are becoming harder to source. Delivery timelines are becoming more important. Premiums in certain physical markets may begin to rise even if the official spot price stays relatively calm. That creates a disconnect. It is entirely possible in a supply crisis for the quoted market price to remain stable while the actual cost of obtaining real metal rises sharply. We have seen that before. During periods of extreme market stress, investors often discover that the spot price and the physical price are not the same thing. That is when physical ownership becomes powerful. If you already hold physical silver, you are not dependent on delivery logistics. You are not dependent on exchange rules. You are not dependent on a third party promising future settlement. You already own the asset. In a tightening market, that position becomes increasingly valuable. Now let's talk about industrial users. If you are a manufacturer, a fabricator, or a company dependent on silver as an input material, the next few months could become very difficult. You face a classic supply chain decision. Do you secure future supply now at a higher price, or do you wait and hope the market normalizes? History suggests waiting can be very expensive. During the rare earth crisis in 2010, companies that acted early protected production. They locked in supply and maintained operations. Companies that waited found themselves scrambling later, often paying dramatically higher prices just to keep factories running. Silver could follow the same pattern. If industrial buyers begin moving aggressively into the market to secure forward inventory, they will increase demand immediately. That demand does not show up gradually. It appears suddenly, and it can drain available supply faster than expected. That creates a second wave of pressure. The first wave comes from reduced Chinese exports. The second comes from industrial stockpiling. And then comes the third wave, investor demand. That is where paper silver becomes important. Many investors believe owning silver through ETFs or futures contracts gives them effective exposure to the metal. Under normal market conditions, that is generally true. But during supply stress, the distinction between owning silver and owning a claim on silver becomes much more important. Take SLV, for example. It is the largest silver ETF in the world and holds substantial physical metal. But investors should understand how these structures work. Not every share represents a simple claim on a specific silver bar sitting in a vault. The system involves custodians, authorized participants, and operational mechanisms that work efficiently during normal market conditions. But what happens under stress? What happens if physical supply becomes harder to source? That is where questions begin. Now look at PSLV. Many investors prefer it because it emphasizes physical backing and stronger delivery credibility that can provide additional confidence. But even there, the trust can only acquire what is available. If the physical market tightens dramatically, obtaining new metal becomes harder for everyone. No structure can create silver that does not exist. And then there are futures markets like COMEX. This is where many investors become uncomfortable. Futures contracts give exposure to price. But most participants never take delivery. That is fine when inventories are healthy and confidence is high. But if registered inventories continue falling and delivery demand rises, exchanges can face pressure. History shows that exchanges protect system stability first. We saw that clearly during the 2022 nickel crisis, when the London Metal Exchange halted trading and even reversed transactions to stabilize the market. That event reminded investors of something important. Exchanges are not designed to guarantee every participant gets physical metal. They are designed to preserve orderly markets. That is a major difference. So if you own paper silver today, assuming you can always convert it into physical metal later, this China export ban should force you to reconsider that assumption. I am not saying COMEX will fail. I am not saying ETFs will stop functioning. That would be speculation. What I am saying is this: the probability of stress in those systems has increased, and that matters, because markets do not need to fully fail to create price dislocations. Even a small loss of confidence can create enormous volatility. Imagine industrial users buying aggressively, investors moving from paper into physical, and available inventories falling at the same time. That is not a normal market environment. That is the beginning of a squeeze. And squeezes do not move slowly. They move in bursts. They move in gaps. They move when most participants are still telling themselves everything is under control. That is why this moment matters. The silver market is not yet in full panic. But the ingredients for panic are clearly visible: reduced supply, tightening inventories, strategic policy risk, rising industrial demand, and growing awareness among investors. That combination can stay quiet for a while, then suddenly, it cannot. Now we arrive at the most important part of this entire analysis. Over the next 90 days, the silver market is going to reveal whether China's export restrictions are simply a short-term political maneuver or the beginning of a true physical supply crisis. And the good news is that we do not need to guess. The market will give us signals. It always does. The key is knowing exactly what to watch and understanding what those signals mean before the broader market reacts. The first signal is COMEX registered silver inventories. This is the most immediate and transparent indicator because it is updated daily. When you look at COMEX data, do not focus only on total silver inventories. That number can be misleading because it includes eligible silver, which is not necessarily available for delivery. The number that matters is registered silver, the category of metal that can be delivered immediately against futures contracts. Right now, that number is already much lower than many investors realize. If registered silver falls below 50 million ounces within the next 60 days, that would strongly suggest Chinese exports were playing a much bigger role in supporting Western supply than most analysts understood. If it falls below 40 million ounces, the market will start paying attention very quickly. And if it approaches 25 million ounces, that becomes a structural warning signal for the entire global silver pricing system.